Hello, my name is Jamie Towers. I'm a tax partner with Mazars in Australia, and today's presentation is all about trust distributions in 2022 and beyond. So what we're going to be talking about is the ATO's new view of anti-avoidance rules for trust distributions and what you need to do to ensure that you stay on the right side of the law. So the general disclaimer is it's just general advice. So it's designed to inform trustees of the ATO's new views about the anti-avoidance rules and allow them to make an informed decision for income distribution resolutions for 2022. It is general advice. Each trust is very different, so you should be also seeking professional advice in relation to your own circumstances. So the things we're going to discuss today is a bit of a trust 101. So what is a trust, how to distribute income. We're going to talk about this anti-avoidance rule that the ATO has suddenly changed their mind on and become very concerned about. We're going to talk about the ATO's view of the world and all of their recent publications in relation to this anti-avoidance rule. And then importantly, talk about what you as trustees need to do in 2022. So the first thing we'll talk about is a trust 101. So a discretionary trust is one where the trustee has the ultimate discretion as to which beneficiaries are going to receive the income or capital of the trust at the end of the year. Now, when the trustee makes that decision, the beneficiary becomes presently entitled to that income or capital. And what that means is that the beneficiary that's been given that present entitlement is allowed to legally call on the trustee to distribute that amount to them. Now, to enable that to occur, the trustee really needs to read the trust deed to understand the trust distribution requirements and how to determine what is income of the trust. So most trust deeds will actually have a written definition of what trust income is. Some trust deeds will say it's income per accounting concepts. Some will say income per ordinary concepts. Some will say income as per the tax law. So each trust deed is very different. So it's really important that the trustee understands what is income of the trust, because that's what's going to be distributed. That's what's going to be made the subject of that present entitlement. So then the next thing that needs to occur is the trustee needs to check which individuals or which entities are valid beneficiaries. So again, they need to read the trust deed. Now, we've had examples of trusts where we've inherited them from other advisors, and there have been incorrect or invalid distributions in the past. So they haven't followed the trust deed. They've purported to distribute to someone in the past. They weren't a valid beneficiary, and that has resulted in the trustee paying tax at the top marginal rate. So it's really important to make sure you're distributing to a valid beneficiary. Now, once you've understood the concept of income, determined who is a valid beneficiary, you can then make a decision as to which beneficiary or which beneficiaries are going to be entitled to the income and or capital of the trust at 30 June of each year. Now, that can be a fixed amount, a percentage, or it could be a combination of the two. Now, in instances where the trust income is different to the taxable income, then beneficiaries are going to be taxed on a proportionate basis. So, for example, if the trust income is $100, but there are some amounts disallowed for tax purposes, such that the taxable income is $200, then the beneficiary will be taxed on that taxable income or the proportionate amount. Now, it's really important that any resolution is recorded in writing. This is the evidence that the trustee will need in the event of an audit to support the fact that that beneficiary has been made entitled to the income. Now, under audits, the ATO will request the trust resolution and will want to make sure that it has been validly made and recorded in writing. Now, ahead of making these income distributions, trustees need to be planning. So they need to be reviewing the financial position of the trust to year to date, estimating what the profit of that trust will be at the end of the year, and then what the likely taxable income will be at the end of the year, to allow appropriate decisions to be made to distribute income to whichever beneficiaries they decide. So again, trustees need to be aware that once a beneficiary is presently entitled, that beneficiary can legally demand payment at any time. Now, some deeds will allow distributions to charities, and there is another anti-avoidance law that says that if charities do get a present entitlement, in order for that to be valid for tax purposes, the charity needs to be notified or paid that amount within 2 months of the end of the year. We'll now talk about Section 100A of the 1936 Act, and this is an anti-avoidance rule that's been in the tax law for over 40 years. Now, the aim of the rule is to prevent trusts making a beneficiary presently entitled to income, but and then another person gets the economic benefit of that entitlement. And in this situation, the person that's ultimately economically benefiting doesn't pay tax on the income, the presently entitled beneficiary does, and there is a reduction of the overall tax payable than if the economic beneficiary would have been distributed to. Now, the aim of the rule is to remove that reduction in tax. Now, there is an exception to the rule for ordinary family and commercial dealings, and we're going to spend a bit of time talking about that because it's really important, and this is where the ATO has really changed their view. So how does the rule apply? So it applies in an instance where a beneficiary has been made presently entitled to income of the trust, and that present entitlement is connected with what's known as a reimbursement agreement. Now, this is a term defined in the law. It's a very broad term, can be any sort of agreement, whether implied, actual, but the agreement basically says that we will make you presently entitled to the income, but this person over here is going to get the benefit of that. So you might be entitled to $100, but we're going to pay the $100 over to this person. So we need a present entitlement in connection with the reimbursement agreement. That doesn't have to be a reimbursement, it's just a term under the tax law. Another person gets the economic benefit or the use of those funds, and there is a tax reduction purpose. So by making someone presently entitled, you're paying a lower amount of tax than if you'd made someone else presently entitled. Now, that tax reduction purpose doesn't have to be a dominant purpose, which is the rule under the general anti-avoidance law. It just has to be a purpose. Now, again, there is an exception to the application of these rules if the agreement, so there is an agreement, but that agreement has been entered into as part of an ordinary commercial or family dealing. So what happens if these rules apply? So if Section 100A applies, then the income that is the subject of that present entitlement is treated as if that beneficiary were not entitled to it. So we've made John presently entitled to $100. Normally he would pay tax on that $100. If Section 100A applies, then for tax purposes, John is no longer deemed to be entitled to that income. So he doesn't have to pay tax on it. Instead, because that income is something that no one's entitled to it, the trustee would be generally subject to tax on the income at the top marginal rate of tax at 47%. So the trustee doesn't get the benefit of those marginal tax rate thresholds. it's all subject to tax at 47%. So that's the way the ATO gets around this anti-avoidance. Now, we've talked about this concept of ordinary family dealings. Now, there's been very little guidance in the law. There's been very little case law on this to date. And accountants and tax lawyers have broadly or generally accepted that any dealings between the trustees and members of the controlling family of that trust are generally going to be ordinary family dealings. As I said, there's very little case law on this, so there's nothing to suggest that that general view has been misplaced. Now, the ATO is differing from that view. So in 2014, it issued some brief guidance as to their view of the world. And they've said at that time that they will be seeking to issue tax rulings to clarify their views around Section 100A. That was in 2014. Now, in February of 2022, the ATO finally issued a draft tax ruling. It also issued a practice guidance statement, which dictates the way that the ATO will approach these issues. And then it also announced a taxpayer alert, which is designed to make the public aware of areas of the ATO's concern. So all up, there were 67 pages of guidance provided in February of the ATO's new view of the world. And we're going to talk about what this view is, because it's really important for trustees to understand that, to make sure that they're well informed ahead of making new income distributions. Now, the ATO's view is very different to that held by accountants and tax lawyers. So they've said that a dealing is not an ordinary family dealing merely because it is commonplace or involves no artificiality. And that's the direct quote from the draft tax ruling. Now, the broad understanding that's coming out of these rulings is if there's no evidence supporting ordinary family dealings, then the ATO may determine that Section 100A applies. Now, very importantly, I will say these are only drafts. So we've got a draft ruling, a draft practice guidance statement. Now, even if they were finalised rules, it's just the ATO's view of the law. It doesn't mean it's the law. Now, some of the statements within the draft tax ruling are actually not supported by case law. So there was a case held on Section 100A very recently called the Guardian case, and some of the commentary or the law in that case disputes what the ATO have said in their draft ruling. Now, the ATO have acknowledged that the Guardian case was issued and they have appealed that case. Now, I do know that that case should be heard, or the appeal to that case should be heard later in the 2022 calendar year. But the current law does dispute some of the commentary within the ruling. Now, the ATO are seeking a test case on their views because they admit that it may not be supportable, and they want a test case to be able to support what they've said. So under the practice compliance guidance statement, the ATO have issued various risk ratings. So and they've gone under coloured zones. So under the white zone, they've basically said, we're not going to look at anything before 2014. Now, why could they look at that anyway? So there's a specific carve out for Section 100A anti-avoidance rules that says the general 4-year review period doesn't apply. If Section 100A does apply, you can go back an unlimited amount. But the ATO tried to be practical. They said, we're not going to go back further than 2014, which was the time of their previous announcement. Now, so that's the white zone. The green zone talks about various situations where they're not concerned with. A blue zone is an increased level of concern, but may still be supportable. And then there's areas in the red zone that they think are anti-avoidance that 100A will apply to. And we'll go through some of the examples. And then importantly, we'll go through what does that 2014 guidance say? Because through this compliance guidance statement, the ATO have said anything that the taxpayers have done in reliance to that 2014 guidance, we're going to accept. And even up until the 2022 year, if you follow the 2014 guidance, you're going to be okay. So we'll talk about these different zones. So some of the examples in the compliance guidance statement under the green zone is the trustee makes an adult beneficiary presently entitled to the income and follows through with a payment of cash. It's not controversial. I'm not even sure why they've raised that. The next example is the trustee has made an adult beneficiary presently entitled to the income of the trust, but leaves the money in the trust for working capital purposes. Now, the ATO said that will be acceptable. We don't think it would be Section 100A if either the beneficiary controls the trust or works in the management of the trust. So if you're not in control or not working in the trust business, so for example, an adult child who might be at university, if they receive some of that income, but they leave it in the trust, well, then that's not what this green zone says. So you must be in control of the trust or in the management of the business for this example. The next example is in relation to you make a company presently entitled to the income, you leave the cash in the trust for working capital purposes, but you convert that present entitlement to a Division 7A loan. The ATO are comfortable with that situation. Now, the blue zone is reported to be any arrangements that don't fit within the white zone, the green zone, or the red zone, but may have some element of each of them. So the examples or the guidance says you may still be safe as long as the situation is explainable for ordinary commercial or family circumstances. And some of the examples include where the funds or a beneficiary is made entitled to the income, the funds are retained by the trustee, and then that beneficiary has gifted the trust entitlement to someone else or has forgiven that entitlement. So that they've paid tax at that beneficiary's lower marginal rate, and they've then said, don't bother paying me. Then the next example is a round robin arrangement, and we'll spend a bit of time with this. The same, there may be circumstances where it is okay, but we're going to have a bit of a closer look at those. But that's, in all cases, the funds are retained by the trustee. Now, the red zone is the dangerous territory. The ATO said in examples in the red zone, we are going to devote compliance resources because we think in the examples given, they would contravene Section 100A. Now, some of the examples in the practice compliance guidance statement are an adult beneficiary is made presently entitled to the income and they gift that money back to the parent as payment for childhood expenses. Another example is a round robin arrangement, which we'll go through in a moment, resulting in tax deferral. Other examples is where the presently entitled beneficiary has losses, and an objective person would say, well, the only reason they got that distribution was because they had losses resulting in lower tax. And then examples subject to the taxpayer alert, which we'll go through next. So the taxpayer alert As I said at the start, it's designed to inform taxpayers of areas of the ATO's real concern. And in this example, I think it's fair enough. This example is the parents have borrowed money from the trust. The trustee has then made an adult's children presently entitled to the trust income up to $180,000. And that the parents are earning above $180,000. Now, the trustee pays the amounts to the parents at the direction of the children to offset that earlier borrowing from the trust. Now, the children have provided that payment at direction or directed the trustee to offset that amount to their parents to repay the costs of their upbringing. Now, the costs of upbringing are always expenses of the parent. The children are minor, they shouldn't ever be responsible for those upbringing costs while they are minors. So the ATO believes by directing that payment to the parents to repay upbringing costs, that's a clear, it's not an ordinary family dealing and it's motivated by tax avoidance. Another example is where the children direct the amount to be paid back to the parents to help pay for the share of current family living costs beyond what is reasonably expected. So again, the examples go along the lines of the children are at university, they're living at home, they would expected to pay board. It might be, let's say, $20,000, but the children have directed the trustee to pay all of that $180,000 distribution back to the parents. Then the third example in the taxpayer alert is where the children direct the money to go back to the parents under an agreement that the parents will manage the pooled family benefits for the benefit of all family members. Now, this one I'm a bit dubious about because I have seen live examples where families do manage the funds for all of the family, and it is a genuine agreement. Again, the taxpayer alert is just raising concerns, and it doesn't necessarily mean that 100A will apply, but it is an area that the ATO is concerned about. Now, if the arrangements that we've talked about are objectively done for tax purposes, then 100A can apply. And again, the principle behind 100A is to make sure that tax is paid at that top marginal rate. Now, when you're thinking about is anything motivated by tax saving, if you think about $180,000 taxed at marginal rates, so for an example, we distribute $180,000 to a child at university, they would pay $55,267 in tax and Medicare levy. If instead of distributing that money to that child, they distributed it to a parent who's already on the top marginal rate, then that parent would pay $84,600 in tax. So it's a difference or a tax saving of nearly $30,000. So certainly an objective person may say that there was a tax avoidance element in some circumstances. We'll now talk about the 2014 guidance because the ATO has said this will apply all the way up to 30 June 2022. So really important to keep in mind for this year's considerations. Now, the guidance broadly talks about examples where it's fairly clear that it would be an ordinary commercial or family dealing. So they talk about bona fide loans. So where the trustee lends money to the parents and that loan is at principal and interest. And they're saying in that situation, we're comfortable that it's an ordinary commercial or family dealing. They've given an example where some interest-free loans might be okay on a short-term basis as long as that principal is being repaid. Now, under the 2014 guidance, They also talk about examples where a company's been made presently entitled to the income and the money has been retained in the trust. And again, the company or that loan has been put subject to a Division 7A loan repayable over 7 years, principal and interest. The tax office are comfortable with that. They've given an example where all the money has been distributed to, all of the income has been distributed to a grandson, and it's been decided he will get all of the income up to the age of 25. Won't be paid it until 25 when he's got a bit of maturity, and it will be released at that point in time. Now, the ATO says as long as the trustee retains it and reinvests it, they're comfortable that that would be considered part of an ordinary family dealing. Now, finally, the final example within the 2014 guidance talks about a variety of children are made presently entitled to income, so adult children. The money's been lent to the parents on P&I principal and interest terms. The ATO are comfortable with that. Now, where the ATO are not comfortable is a round robin arrangement, which we've mentioned a couple of times. Now, this is an example where a trust, which is a shareholder in the company, makes the company presently entitled to the income. Now, the company pays tax at 30% on that income, but the money is retained in the trust. If the trust didn't pay that money back to the company, then that would become subject to a Division 7A dim dividend. So the trust pays that money to the company, but the trust really needs it for its own working capital. So then the company pays a dividend back to the trust, a fully franked dividend in the next year. Then the trust distributes the income back to the company, and because it's a fully franked dividend, no further tax is paid. And it keeps going around and around and around. So the ATO says, well, we think the objective purpose behind this is to cap that tax rate at 37%. If the trustee had retained that money itself, it would have paid tax at 47%. So there is a clear tax saving to be had. They said, we don't like this. We think this is an area that 100A would apply to. So we've talked about the ATO's draft tax ruling, the ATO's draft practice guidance statement, and the taxpayer alert, and what the ATO considers to be okay in 2014. So we're coming to the end of the 2022 financial year. Trustees may need to make a decision by the 30th of June as to who to distribute income. So what do they need to do? We can't just do what we did last year, copy the trust minute over. That's not going to cut it. You need to think about what the ATOs are looking at and make sure that you are comfortable in what you are doing in making those distribution resolutions. The trustee needs to remember that if you're making adult children presently entitled to the income, the children could sue the trustee to collect that money, or could ask at the very least, and if not, then sue. So importantly, you don't leave it to the last minute. There's no one-size-fits-all solution. The trust deeds are very different, families are very different, and situations are very different. So you need to, again, review the trust income year to date, estimate what it's going to look like at 30 June, and then consider how you are going to distribute that income. As we've said, if it complies with the 2014 guidance, then the ATO are comfortable that it's not going to be caught by Section 100A. If you're not following the ATO guidance, you need to be comfortable that it is an ordinary family or commercial dealing. Now, keeping in mind, this is what we've talked about is just the ATO's view of the law. Some of it is not actually supported. We're going to be having the Guardian case appealed later in the year. the ATO are also calling on a further tax case to support their views. And after that, we're hoping the ATO will wait until after that tax case before they issue the final ruling. So trustees really need to take a risk-based approach. So be comfortable that the risks that you are taking as a trustee are either supported by the 2014 guidance, or you are comfortable that it is a genuine commercial or family dealing. And if the ATO disagrees, be prepared to challenge that. So if you don't follow the ATO's views, then you're at greater risk of challenge. Now, I would be recommending to avoid those red zones. Some of them, I believe, are genuine cases where Section 100A could apply. Some of them perhaps not, but that's the ATO's view of the law. Now, if you want a totally risk-free approach, if you are paying money to adult children beneficiaries, pay the money to that beneficiary. The ATO cannot dispute that. If the money has followed the distribution or the present entitlement, Section 100A cannot apply. Now, if the money is not paid to the adult beneficiary straight away, consider having the beneficiaries acknowledge their present entitlement. So at least they are aware of it. The ATO knows those beneficiaries are aware of it. If they choose not to call on the trust straight away, that might be an indication that they're doing it to benefit the family. So at least acknowledging it, the ATO are comfortable the beneficiaries are aware of that. But I think because all trusts are different, all situations are different, you really need to take advice in relation to your trust's own circumstances. So I'd highly recommend you speak with your Mazars advisor about the most appropriate solution for the circumstances. Now, once you've talked about that, record your decision in writing by the 30th of June, or perhaps earlier if the trust deed requires it earlier. So these are just some thoughts and ideas about how to distribute trust income in 2022. Now, the law is evolving. The ATO's views, we hope, will evolve as well following the Guardian appeal and potential tax case appeals. Section 100A can go back for an unlimited time period. So if you have had situations in the past that potentially go against what the ATO has said is okay, you need to be talking to your advisors about that. We may not have an immediate solution and be waiting on the guidance in the tax case, which hopefully comes up in the Taxpayers decision. But you need to be talking to your advisors, taking advice, and then taking steps that are appropriate for your situation. Now, I'm Jamie Towers. I'm a tax partner in Brisbane. Other tax partners that you can contact are Evan in Melbourne and Gabrielle in Sydney. But I'd advise you to reach out to your general day-to-day Mazars advisor to talk to them about your trust resolutions. But if not, feel free to reach out to one of the direct tax partners. Now, thank you for your attention. I hope that it's been informative, and good luck for 2022. Thank you.